Picture this. You just closed on your house, keys in your hand, the paperwork is signed, the banker is shaking your hand, your realtor is hugging you. The notary is already packing up his briefcase. Somewhere in the background, somebody brought champagne. Your mom called twice. You let it go to voicemail because you were signing something, and then you called her back from the parking lot, and your voice cracked a little, and you told yourself it was the adrenaline. You own something, a real asset, equity. Every single month you write that check, and somewhere in your head a voice says, "I'm building wealth. I'm getting richer with every payment. 30 years from now, this house is mine, free and clear." That voice feels true. It feels true the way a lot of things feel true when you're standing in a kitchen that's finally yours, with keys in your hand and a mortgage you qualified for, and a rate your loan officer called competitive for the current environment. You feel like a homeowner. You feel like someone who made the right move. You feel like your parents always said this moment would feel. That's real. And it's also not the whole story, because there's a document your lender hands you at closing. It's buried somewhere around page 40 of a 3-inch stack of paperwork. Most people sign it, fold it into the stack, put the stack in a file cabinet, and never look at it again. Some people put the stack in a box. Some people put the box in a storage unit and forget which storage unit. Some people move twice and find the box in the garage of the second house, still sealed. It's called an amortization schedule. And if you actually read it, column by column, year by year, it changes the math entirely. Not the outcome, just the picture of how you get there. And sometimes, how you get there is the entire point. I want to show you one column in that table, just one. And by the end of this video, I want you to understand why that column is the only number that actually matters before you sign. My attorney would like to note, before we continue, that nothing I'm about to say constitutes financial advice. My attorney also asked why I keep making videos specifically about mortgages. I told him the numbers are interesting. He said, quote, "Alistair, the numbers are always interesting. Please disclose something first." So, disclosed. He reviewed this script on a Tuesday. He flagged 2 sections, suggested I soften a third, and billed me for 1 hour and 15 minutes. He'll send an invoice by Friday. He bills for Fridays. Here's how a 30-year mortgage works. Actually, here's how it really works, which is a slightly different conversation than the one you had with your loan officer. You borrow $400,000. Your rate is 7%. Your monthly payment lands at $2,650. You'll make 360 of those payments over 30 years. By the time you write the final check, you've paid $958,000. For a $400,000 house, $558,000 in interest. Most people know this number in the abstract. They wince, they nod, they say something like, "Well, you have to live somewhere." And then they move on because the monthly payment feels manageable, and 30 years feels very far away. What nobody shows you is how that interest is distributed across those 30 years. The total is disclosed. The distribution is not explained. Banks use what's called a front-loaded interest schedule. The mechanics are straightforward. Every month, your interest is calculated on your remaining loan balance. In month 1, your balance is $400,000. 7% of $400,000 divided by 12 months equals $2,333 in interest per month. Your total payment is $2,650. So in month 1, $2,333 goes to the bank as interest. $217 reduces your actual loan balance. $217 on a $2,650 payment. That's 8% of your check buying the house. The other 92% is the cost of borrowing the money. By month 12, you've made 12 payments. Total cash out of your account? $31,800. Of that, roughly $27,600 went to interest. About $2,600 went to principal. After 1 full year of on-time payments, your $400,000 loan balance is approximately $397,400. You paid over $31,000 to move your balance by $2,600. By year 3, 36 payments in, you've sent the bank about $95,000. Your remaining balance is still somewhere around $388,000. You've reduced principal by roughly $12,000. Over $83,000 went to interest. By year 5, 60 payments in, you've sent roughly $159,000. Your remaining balance is still around $373,000. You've reduced the principal by approximately $27,000. More than $130,000 went to interest. And I want to be precise here because this matters. This is not dishonest. The math is completely accurate and fully disclosed. When you owe $400,000 at 7%, you genuinely owe $28,000 a year in interest. Divide by 12, that's your monthly interest bill. The bank isn't hiding this. They give you the full schedule at closing. They just know with very high confidence that you won't read it. Open any browser tonight. Type Mortgage Amortization Calculator. Enter your loan amount, your interest rate, your remaining term. Click the button that says Show Full Schedule or Show Payment Breakdown. Find Year 1. Look at the column labeled Principal Paid. Now scroll to year 25. In year 25, on that same $400,000 loan at 7%, your monthly principal payment has climbed to somewhere around $1,900. Your interest portion has fallen to roughly $750. The math has quietly reversed. You're finally paying more house than bank. That crossover, where principal paid per month exceeds interest paid per month, happens around year 20 to 22, depending on your rate. Before that point, the bank is collecting more of your payment than your balance is shrinking. After that point, the equity curve finally accelerates in your favor. The question is, will you still be in that house when it does? I want to stay fair. This is not a scam. The system isn't broken. Compound interest has always worked this way. Interest accrues on the outstanding balance. The balance declines over time. The interest portion declines too. Perfectly logical structure. The problem isn't the math. The problem is the framing. You feel like a homeowner from day one. You say, my house, my equity, my investment. All of that is technically accurate, but there is a meaningful gap between what that language implies and what the amortization table actually shows. And that gap is worth understanding, especially when the median American homeowner doesn't hold a mortgage long enough to reach the part where the math starts working for them. Let me introduce you to Marcus, 38 years old, household income $95,000 a year. He and his wife buy a $400,000 home in 2022, 7% fixed rate. He's proud of the decision, tells his parents, tells his co-workers. He posts a picture of the keys on his phone. He genuinely believes, because he was told, and it isn't wrong, that he's building wealth. In his mind, every payment is a deposit into his own future. That's the frame the whole system handed him, starting with the conversation at the bank, continuing through every piece of financial content he'd ever read. Pay down the mortgage, build equity. That's wealth. 7 years later, Marcus gets a promotion that requires relocation. A real opportunity, the kind you don't turn down. He and his wife decide to take it. He lists the house, accepts an offer, and sits down at the closing table for the second time in 7 years. In those 7 years, Marcus made 84 monthly payments. Total cash paid toward the mortgage, roughly $222,000. He also paid property taxes, insurance, and maintenance on top of that. But let's stay with the mortgage alone. How much of that $222,000 reduced his loan balance? Approximately $52,000. $170,000 went to interest. Marcus received some market appreciation in his area, which helped his net sale position. He didn't lose money on the transaction. But from his monthly payments alone, the $222,000 he paid in over 7 years, he recovered about 23 cents of principal for every dollar sent to the servicer. He built equity, just not at the pace the framing implied. Here's the number I want you to hold on to. The median home ownership tenure in the United States is approximately 7 to 8 years. That's from the National Association of Realtors. Not my estimate, not a dramatic framing. That's the data. The average American family sells their home before the amortization curve has fully turned in their favor. They sell during the exact window where the front loading is working hardest against them. I mentioned this once to a former colleague who spent 2 decades structuring mortgage-backed securities. We were having dinner, no cameras, no quotes. I brought up the median tenure number. He didn't seem surprised. He said, "The schedule isn't designed around 30 years. It's designed around when most people actually hold the loan." He wasn't being cynical. He was being accurate. The bank modeled the data. They built the structure accordingly. The amortization schedule front-loads interest during the exact window when, statistically, most borrowers are active. That's not conspiracy. That's product design. Transparent product design. The schedule is right there, on page 40. Pull up that amortization schedule. Find the row for month 84. That's year 7. Look at the column showing total principal paid to date. Add your original down payment to that figure. That's your equity from payments alone, independent of any market movement. Now calculate your total payments over those 84 months. Your monthly amount times 84. The difference between those two numbers is what you paid the bank to hold your loan for 7 years. Write it down in actual dollars, not a percentage, dollars. A specific number with a comma in it, maybe 2 commas. Then ask yourself, honestly, did you factor that number into your decision when you bought? When you were sitting across from the loan officer, running the monthly payment against your take-home pay, did someone put that figure in front of you and say, here's what 7 years of this loan actually costs? Most people didn't see that number, not because they were careless, because nobody walked them through page 40. I'm not arguing against buying a home. That is not what this video is, and it's not what the math says. What the math says is, the asset is real, the equity is real, the long-term value is real. But the framing you received, every payment makes you richer, you're building wealth from day one, is incomplete in a specific and important way. You are building equity, just slowly, through a structure that is most profitable for the lender during the exact window when most people actually hold their loan. Knowing that doesn't make the house a bad decision. It makes you a better decision maker the next time you sit down at a closing table, or the next time someone you know is about to sign. Here's the good news, and I mean genuinely good news. Not the variety that financial content creators deploy right before asking you to click something. There is one adjustment, completely free, requiring no new products and no refinancing, that changes the amortization math meaningfully in your favor. Bi-weekly payments. Instead of one full monthly payment, you make half that amount every 2 weeks. The mechanism is simple. There are 52 weeks in a year. Pay every 2 weeks and you make 26 half payments, which equals 13 full monthly payments instead of 12. One additional full payment per year applied directly to your principal balance. That one extra payment compounds. Your principal declines slightly faster, which means slightly less interest accrues the following month, which means slightly more of your next payment goes to principal, which means slightly less interest the month after that. Multiply that compounding effect across 26 or 27 years, and the numbers become genuinely significant. On a $400,000 loan at 7%, your payoff date moves from year 30 to approximately year 25 or 26. Your total interest paid drops by somewhere between $55,000 and $85,000, depending on your exact rate and remaining balance. Some borrowers at lower rates see savings closer to $45,000. Some at higher rates see over $90,000. The range is wide. The direction is consistent. For making half your payment every 2 weeks instead of the full amount once a month. No seminar, no financial product, no referral link. One change to your payment calendar. 3 steps. Step 1. Contact your mortgage servicer by phone or through your account portal. Ask specifically, do you accept bi-weekly payments? If you do, are they applied to principal on the date received or held in suspense until the full monthly amount accumulates? Write down exactly what they tell you and who told you. That second question is the one that matters. Get a name. Step 2. If they apply payments immediately to principal, set up automatic transfers for exactly half your regular monthly payment, scheduled every 14 days. Most online banking systems handle this without a phone call. Set it, confirm the first 2 transfers posted correctly, and leave it alone. Step 3. Run your updated amortization. Enter your current balance, current rate, remaining term into any free calculator online. Add the equivalent of 1 extra full payment per year in the Additional Annual Payment field. Look at the new payoff date. Look at the interest savings figure. That number is what this change is worth, specifically to your loan with your balance at your rate. Do that math before you commit to anything. Now, I need to stop, because everything I just explained is accurate, useful, and completely irrelevant to a significant portion of you watching this. Not because the math is wrong, because of terms buried in your specific loan documents that make the bi-weekly approach either impossible, ineffective, or simply not the right move for your situation. Let me tell you who this doesn't work for. Scenario 1. Prepayment penalties. Some mortgages, certain adjustable rate products, some loans from the mid-2000s, various state-specific programs, contain a prepayment penalty clause, a fee charged specifically when you pay ahead of schedule. These penalties can run 2 to 3% of your remaining balance. On a $350,000 balance, that's $7,000 to $10,000. The bi-weekly strategy only saves you money if you're not being charged a fee to apply extra principal. If you have a prepayment penalty clause, you could accelerate your payments for 2 years and hand back everything you saved, and then some, in fees. Before changing anything, open your original closing documents. Search for the words prepayment penalty or prepayment charge. If you find them, read the conditions carefully, including the term length. Most penalties have a fixed window, often 3 to 5 years from origination. If you're past that window, you're generally clear. If you're inside it, the strategy still works mathematically, just not yet. Scenario 2. Servicer restrictions. Some mortgage servicers will accept bi-weekly transfers but will not apply them on the date received. Instead, they park each half payment in what's called a suspense account until the full monthly amount accumulates, then apply at once at the normal due date. If that's how your servicer handles it, you're not paying early. You're splitting the same payment into 2 transactions, handing them an interest-free float on half your money for 2 weeks, and gaining nothing in return. When you call, ask this exact question. Are bi-weekly payments applied to principal on the day received, or held until the full monthly amount is on hand? The answer tells you everything. If they hold the funds, the bi-weekly structure doesn't work through that servicer. Your alternative is simpler. Make 1 extra full payment per year in any month you choose, clearly designated for principal reduction. January. Tax refund time. A bonus month. It doesn't matter which month. What matters is that you label it Apply to Principal explicitly in writing and verify it was processed correctly. Same mathematical result, different mechanics. Scenario 3. You're planning to refinance. A lot of people watching this are waiting for rates to drop. If your situation involves refinancing within the next 2 or 3 years, and you've done the math, you know the break-even point, you have a clear plan, then bi-weekly payments on the current loan have a much shorter runway than the projections suggest. You accelerate paydown for 24 or 30 months. Then you refinance. The new loan resets the entire amortization clock at a new balance and a new rate. And the new loan starts front-loading interest again from the beginning, the same way the first one did. In a refinance scenario, the more valuable move isn't bi-weekly payments on the current loan. It's understanding what the new amortization schedule looks like before you sign the refinance closing documents. It's asking your loan officer at the new closing table the same question I'm asking you to ask now. In year 1, how much of my payment goes to principal? Which is exactly the same question most people didn't ask the first time. Here's the only thing I actually wanted to tell you today. Not the bi-weekly strategy. Not the year 7 equity calculation. Not the $558,000 interest total over 30 years. This. Read the amortization schedule before you close. Not after. Not 3 months into home ownership when someone sends you a video like this one. Before. Before the handshakes. Before the keys. Before the champagne. Before you've already committed to the numbers on the page. The schedule is right there in the closing package. It's a few pages long, clearly labeled, required by law to be provided. Ask your loan officer to walk you through it. Ask them specifically, in year 1, how much of my monthly payment goes to principal? In year 7, the year the data says I'll probably sell, how much equity will I have built from my payments alone, not counting any market appreciation? Watch what they choose to explain. Watch what they move past quickly. Watch whether they slow down on page 40 or turn through it without stopping. The information is not hidden. The math is not secret. The document exists every time, for every mortgage, at every closing table. It's just on page 40, and nobody stops the closing to say, "Before you sign, there's a column in here you should understand. Let me show you what happens in year 1 versus year 25. Let me show you where your money actually goes for the first 7 years." Nobody says that, so I'm saying it. My attorney reviewed this script. He flagged 2 sections and billed me for 1 hour and 15 minutes. Neither section was financial advice. He also suggested I soften the part about how the amortization schedule was designed around median tenure. I told him it was a quote from a dinner conversation. He said, "Alistair, dinners don't have legal standing." I told him neither does ignoring page 40 of a closing package. He sent me an email with 3 question marks. I took that as approval. "If you have a mortgage, find that amortization table tonight. Open the filing cabinet. Open the box. Open the storage unit if you have to. Find the schedule. Find year 1. Find the column. If you're about to sign one, find page 40 before you pick up the pen. Ask the question out loud at the table before you initial anything. And if someone you know is buying a house for the first time, a younger sibling, a friend in escrow, a coworker who just announced they're under contract, send them this. Because the conversation that should happen before closing, the one about the 1 column on page 40 that almost nobody reads, should happen before the ink dries, not after." That's all I wanted to say.